Hi, thanks so much for tuning in. You're watching the Mutual Fund Show on BQ Prime, and my name is Alex Matthew. Now, the topic that we've decided to talk about today is twofold. The first is that actively managed large cap funds have once again underperformed the benchmark. This is based on a Spiva report that came out not too long back. It's not a new story. So what we're going to be asking our experts today is whether or not there's a strong case now more than ever before to have a passive strategy when it comes to your core portfolio. For your satellite portfolio, and this is where the second leg of the conversation comes in, that is going to be the alpha generator if you choose to have a passive approach in the core portfolio. So how should you construct a satellite portfolio? And finally, we'll also delve a little deeper into a conversation about IT as a theme, because that clearly is the flavor of the week, and in fact, over the last couple of weeks. My first two guests today are Amol Joshi of PlanRupee Investment Services and Aditya Shah, the Chief Investment Officer of GST Investments. Thank you so much, gentlemen, for taking the time. I'm going to toss it to you first, Aditya, just to get a sense as to why this underperformance has taken place yet again. It's quite stark. Now, the Spiva report talks about 88% of large cap actively managed funds having underperformed the benchmark. The benchmark in this case is the BSE 100. Should you take that as a bit with a pinch of salt, or would you say that this is now par for the course?
Good evening, Alex. I think this is par for the course. I believe that the large cap funds will not be able to sustain a substantial alpha over the index, and therefore there's no point investing in them. Firstly, we need to understand the functioning of the large cap funds. If you go to a direct plan, you pay nearly about 1% as a expense ratio, and if you go to a regular plan, you pay about 2% of expense ratio. Given the fact that under the SEBI's recategorization norms, 75% of the investments need to be in the large cap category, it is very hard for these funds to generate about 2% of hard performance. So now what is really happening is increasingly funds are finding it very, very difficult to beat the index, and that is going to stay par for the course because of the SEBI's recategorization norms. So all in all, in my opinion, large cap funds, active large cap funds are a no-no at this point in time. Better to stick to index funds. There are loads of index funds now available in the market, and active funds can be looked at in the other categories, not in the large cap category as such.
Fantastic. Amol, I'll toss it to you as well. Why is this underperformance taking place? And a similar question, does this continue to take place? Is there any way for them to change this trend that has now emerged in the course of the last several years?
Hi, Alex. Alex, you mentioned should we take it with a pinch of salt or par for the course? I would say there is bit of both. We heard one side about the expense ratio from Aditya. I can add a couple of more points. Let me say that not just actively managed funds, but actively managed funds as well as passive funds like an index fund, by design will not be able to beat the benchmark. I'm talking in this case of passive, because we are excluding one very important component, and that is the expense ratio component. A professionally managed product available to retail from 100 rupees to without any limit, you will essentially have some kind of expenses over there. So expenses are not looked at, number one. Number two, schemes also have sectoral or group limits. We recently saw one of the largest groups and all the companies in that group faced pressure on their share price anywhere from 60% to all the way to 85%. To avoid that, there are norms via which a scheme cannot have more than 10% or more than 15 or 20% for sectoral and group exposure. An index can certainly have that. The largest stock in the index, Nifty 50, is currently contributing 60% to the weightage. So these are certain limitations because of which, and of course, people come to, nobody can hide from the fact that people essentially come to actively managed funds to score something over and above. But you should also look at points like expense ratio, impact, cost, and exceptional circumstances that we mentioned. Having said that, passive fund, active fund, both products, both routes are open to you as an investor. Anything that takes you closer to your financial goals is the right choice for you.
Okay, but Aditya has already given his view as to what you should do in the core of your portfolio. He very clearly says that a passive approach is what you should take. Do you concur with that? And in this case, if we're talking about core versus satellite, How do you construct that?
So I would say second question first, core versus satellite. I would say that around for aggressive risk profile investor within equity also you have people with various degrees of risk appetite because we have wide choices from equity oriented funds that do have some kind of debt component in it too. But a pure equity investor with a aggressive risk profile can invest about 50 to 60% of the portfolio into the large cap space. Active or passive is your choice, but within that also you can have a split. There are various types of analysis that you can do. A scheme that does well across market cycles, especially based on rolling returns, can have some exposure from the large cap space within actively managed funds. Remaining 40%, 35-40% of the space, you can build it around a mid cap and small cap diversified portfolio. I'm not sure by satellite if you really mean about thematic, because in your opening remarks...
I'll come to that in a bit. What I was essentially getting at is, would you concur in saying that that core can be completely passive? And we'll keep it short and then we'll move to the next leg.
Right. See, Alex, that can be completely passive. There is nothing that stops you from making that choice. So yes, it can be completely passive, especially if you believe that the future is very, very difficult for a fund manager to generate alpha given all the constraints.
Fantastic. So we are in concurrence. We say that you can build a core portfolio out of passive. Now the question is how? Because Aditya, we're talking about these large caps or actively managed large cap funds that are benchmarked against the BSE 100. And that is because Spiva essentially is doing this in partnership with S&P, but also because AMFI categorizes large cap as the top 100 stocks. So therefore, from that perspective, what is the best approach when you're constructing a portfolio of mutual fund schemes or even one single mutual fund scheme? Should you have only Nifty 50, combination of Nifty 50 plus Nifty Next 50? What is the ideal solution according to you?
See, Alex, even if the Spiva data compares it to the BSE 100, even if you compare it to the Nifty 50 index, you'll find most of these large cap funds underperforming. The first point. The second point is, what is a good strategy? As you have correctly said, the Nifty 50 index fund should be a core part of your allocation. Together with the Nifty 50, Nifty Next 50 index fund should be part of your portfolio. Both of these funds are available from multiple AMCs. You can go ahead and invest based on the tracking error and the expense ratio that the companies are really providing you for. But in my base case, there will be the Nifty 50 index fund and the Nifty Next 50 index fund. I will not go for the Sensex fund because the Sensex fund is not that correctly managed and it is not as diversified as the Nifty 50 and the Nifty Next 50 index funds. So these funds will be core part of it.
Follow up to that then. Since you mentioned tracking error, I'll come to Amol on tracking error, but could you give us what a good TER should be on a passive fund? And if you have recommendations on which passives to choose with the Nifty 50 and Nifty Next 50, could you please give us those?
So what really happens is, first of all, what is tracking error? The return that the Nifty will get and the return on your passive fund, there will be a difference between both of them, and that difference is broadly known as the tracking error. Generally, what happens is mutual funds are not able to the Nifty churns itself twice a year, and the mutual funds are not able to churn their portfolios as frequently as the Nifty would be. So the tracking error will arise. So how do you beat the tracking error? The funds which have a higher AUM, they will be able to do it very, very easily. So in my case, if I were to recommend two funds, you could go for the UTI Nifty 50 index fund and the UTI Next 50 index fund. Those funds, because of their AUM and a good track record over the past 5, 7, 10 years, have the least tracking errors in my view. Then you can go for the funds that have been introduced by the newer companies such as the DSP one. But I will suggest that the UTI ones are the best ones since UTI has been coming out with this product for a longer period of time.
Fantastic. Amol, do you have anything to add in terms of tracking error, in terms of what you need to bear in mind, just from the perspective of an investor making a choice between various fund options?
Right. So Nifty index design, or for that matter, any index design, is more of a theoretical exercise, right? Based on the set parameter of market capitalization, free float, etc., you can design the index. But actual scheme running, you will essentially have to look at how the market behaves. The stock prices are moving. When the market is open, the stock prices are going up and down all the time. But the NAV is declared only once at the end of the day. So there are various things that in real life scenario fund manager has to manage, including exceptional circumstances. We'll try to quickly cover both of these in one or two lines. If you get a large inflow or large outflow, that can sometimes, in Nifty, the problem is very, very less. But since we are talking passive in general, that can also sometimes affect your buying and selling ability, or it can impact the prices of the underlying security shares. That is one aspect. Second one, I mentioned exceptional circumstances. So we also had one of the banks getting into a lock-in of 3 years. The prices were written down at 75%, and you still had to hold it for 3 years. And then at the end of 3 years, it got liquidated. And that's when the money came back. These are exceptional circumstances. These will not reflect into the index. As I said, it's a theoretical concept, but this will certainly affect a fund that works in real life environment.
Fantastic. Okay. So we've talked about the first leg. Let's talk about the kicker or the alpha generator, which is the satellite allocation, as I mentioned. Amol has talked about 50% on an average that you would set towards your core portfolio. Aditya, I'm coming to you on this one. In that satellite allocation, obviously, this is a decision that you should take based on your risk profile, etc. But how would you explain and give an idea to somebody that's looking to construct that portfolio today?
See, what really happens is I'm very clear with my mutual fund strategy. Large cap allocation towards index funds, which is the core allocation. And then you can create a satellite portfolio where you can include a flexi cap fund. On the flexi cap fund, it gives the portfolio manager enough ability to invest across market caps, and the fund manager can decide whether he wants a large cap bias or a small cap bias or a mid cap bias. So that's one part of the portfolio. And then depending on the risk profile, if the investor really wants to have a mid cap or a small cap fund, depending on whatever the risk profile is, then you can include that. But those are the places to go for active fund management of flexi cap fund, where the returns could be comparatively higher because the fund manager has got the flexibility to invest anywhere in the market universe. That's one. And then the mid cap and the small cap funds.
Would you like to give any recommendations here?
So if you look at the flexi cap funds, companies like Parag Pareg are doing really well, or a Canara Robeco flexi cap fund is doing really well, or a DSP flexi cap fund, they're also doing really well. On the mid cap and the small cap side, only those who are very, very highly risk tolerant should go ahead and invest in those funds, because the time horizon needs to be 7 to 10 years if you go ahead and invest in those kinds of funds. And then again, there's a DSP small cap fund, an SBI small cap fund, or a Nippon small cap fund that are doing really well, where you can go ahead and invest. But the risk profile needs to be monitored. And on the satellite portfolio, I will dominate it with the flexi cap.
Amol, what is your view in terms of construction of satellite portfolio? And you can also give us your fund recommendations.
Sure. So as I mentioned, after large cap, you can certainly look at mid and small cap dedicated allocations, so that overall on a portfolio basis, you will have that mix of 60-40 or 50-50, that kind of a thing. So within small cap, I would like to suggest ICICI Prudential small cap fund or a Nippon small cap fund. Within mid cap, you can look at combination of large and mid cap, something like HDFC large and mid cap fund, or pure mid cap, you can look at Motilal Oswal mid cap fund as well.
Understood. Aditya, just to follow up, because you've suggested flexi cap, one of the issues that the category had was its tendency for a large number of these funds to have an orientation towards the large cap space. Is that a negative in your opinion?
See, in my opinion, if you take a look at the Parag Pareg flexi cap fund, I have known them to invest where they find value and it matches the thesis of their investment. So good flexi cap fund will not have a bias. However, I do agree with you that a lot of funds tend to show a large capish bias. Then you have to go fund by fund and then try to analyze what's really going on. In my opinion, if you look at the Parag Pareg fund, they invested in ITC in 2018 when nobody wanted to invest. Today, they are investing in a company called HDFC and HDFC Bank, and nobody wants to invest in the stock price is not given return. So I'm going more by the stock, the fund manager's conviction. if they're able to stick to their conviction, they will get outperformance after certain duration of time. And that's what we need to clearly monitor.
Yeah, and incidentally, we had the fund manager on this very show just a short while back, and he pointed out that he's currently holding, or when we spoke to him, he said that he was holding about 20% cash, which is quite a substantial amount of cash to hold. Last views, gentlemen, on thematic and sectoral funds, since I'm going to have a conversation that I had with a fund manager of a tech fund in just a short while. What's your view on these funds and specifically on the IT space? Any views? Amol, I'll come to you first.
Alex, in our opinion, you come to mutual funds for the simplicity that it offers. You do not want to take the burden of decision making after you choose the schemes. Okay, then for a few years you are set. If you are a person who wants to keep it safe, I would like to say that any sectoral theme or one particular theme, thematic funds, sectoral funds are best avoided. What it needs is you need to time the entry as well as exit well. I can quickly give you an example with numbers to back it up. Take the example of Nifty Pharma. From 2015 to 2020, for the span of 4.5 to 5 years, Nifty Pharma index lost 55%, and some of the stocks lost about 80 to 90% of their value. And after that, after losing 55% all these 5 years, during the pandemic, one would have thought it will do very well. It did. It rose from the bottom. It went up by about 160, 170%. But tell you what, Nifty also went up by similar percentage counted from the 23rd March bottom. Now, if you cannot do the consistent timing right, if you cannot get it right, entry as well as exit, sectoral funds, thematic funds are not for you. You also mentioned specifically about IT. Now, we took one example of underperformance in the last phase. Take one example of outperformance. IT, when the index Nifty went up 160 from the 130% from the March bottom, IT actually went up by 240%. But now the index is down 35 to 40% and Nifty is barely 5 to 6%. So even at the outperformance, you do not know what next 6 months have in store for you when the value drops by 40%. I would say if you are a mutual fund investor, please stick with diversified mutual funds. Need not really venture into sectoral or thematic funds.
Aditya, any quick views here?
Yes, as Amol correctly said, that entry and exit to a sectoral fund needs to be correctly timed. It is not for 99% of the retail investors. They should stick to diversified funds. However, for those 1% of the investors who want to go ahead and take exposure, this is a good time to start adding the technology fund with the view that you will not make returns over the next 1.5 to 2 years, post which you can make a return. So slow and steady, exactly for those 1% investors who want to take exposure to the sectoral fund. It's a good time in the technology space.
Fantastic. Gentlemen, thank you so much for sharing your views. And viewers, do stay tuned because the second half of this show is dedicated to a conversation that I had with the fund manager of ICICI Prudential's AMC's technology fund. And that's coming up just now. All right, so you've gotten a bit of a flavor of a core and satellite allocation when it comes to your mutual fund portfolio. The flavor of the week, when we talk about sectors and we talk about earnings, has to be the IT sector. And my next guest is going to be able to give you a little more perspective than you probably have at this juncture about the wider trends, not just in the IT space, but in the tech space as a whole. My guest is Vaibhav Dusad, who is fund manager at ICICI Pru AMC. He manages the tech fund as well as the focus equity fund. Vaibhav, thank you so much for taking the time and for speaking to us on the Mutual Fund Show on BQ Prime.
Thank you, Alex.
Now, I do want to ask you, first of all, about tech. And before delving deeper into IT, let's talk about broader tech. Because I think there were a lot of expectations that built up over the course of the pandemic and that reflected in stock price movements. That seems to be unwinding to a certain extent. Would you say at this juncture that some of those expectations, or quite a lot of those expectations, have been reset?
I think you see a lot of growth came in technology sector across the world, including India. During COVID. That was an instance when there was a sudden urgency for corporates around the world to pivot their legacy old systems, something which can work remotely and in real time basis. I think what has happened in last 12 months, there has been a increase in the interest rates which has happened in US, and because of that, I think while at the moment US economy is still strong, but there has been some impacts from sentiments as well, specifically after this SVB crisis. There has been some impact in terms of sentiments, in terms of spending as far as IT and technology is concerned. I think because of that, there has been some moderation which we are facing at the moment. You have seen a couple of results already, and the expectation is that FY24 uh, growth would be fairly moderated versus what you see in last 2 years. That is the first point. I think the second point is the growth which you have seen in last 2 years. A part of that was, kind of supernormal growth. A part of that is not sustainable, I would say, right? So that growth would not. I don't expect that kind of growth to come back again. And to that extent, valuations have fairly moderated from those levels. Now, going forward, perhaps what can happen in next 2 3 years, whatever growth we would be losing in FY24 in this coming year, some of that growth can come back in following years, next 1 to 2
How
years.
so? How will it come back?
Yeah, so I think the basic thing is that technology adoption, technology migration cycle, which started somewhere in 2018, 19. That cycle is typically 5 to 7 years journey. Today, if you see, we are somewhere in middle of that cycle. The cloud penetration across the world has reached to 30-35%. It used to be 12 to 15% before COVID. Last 2 years, there has been an acceleration journey towards moving towards the cloud migration. And I think next 2 3 years, the expectation is basically we could perhaps reach to 55, 60, 65% of cloud adoption. And I think from there on, I think it is more of an optimal level. We may not see a significant growth from there on. So
Okay.
part of this journey is still pending. And apart from that, the second leg of growth, which would also emerge after some time, would be development of cloud native applications. So a lot of work is pending as far as cloud native application development work is concerned. So that would provide a second leg of growth, but that would be more of a steady state in nature. But nevertheless, it will add certain percentage growth points in the existing industry revenues.
I'm actually curious about your perspective on what we've seen so far. As we're speaking right now, we've had two major IT companies report their earnings. And one of them was a huge surprise that was seen by the street and by everybody, analysts included. They weren't anticipating that kind of a change in commentary. One, as a fund manager of a fund that very specifically looks at IT companies and tech, how do you view both the results in black and white as well as the commentary from the management? And do you anticipate that this is going to be restricted to a few companies, or do you think that it's going to be something that is all pervasive? It's going to extend all the way to the small companies as well.
So I think what these companies have mentioned is some kind of demand moderation, and that is more a broad-based kind of stuff. There could be some company-specific issues, but they are not very clear at the moment. Only when results for everyone is out, we will able to understand better. But at a micro level, it also depends on the kind of exposure you have in each of these verticals, and within verticals in each of these sub verticals, and then whether you have higher exposure in telecom, retail, banking, and so on and so forth. So performance is a function of all of those things, and then the quality of the clients which you have. But if you see, I think this has happened multiple times in past, in GFC, in 2014-15, then during COVID. I think generally whenever there is a sharp drop in the revenues in a particular quarter, I think in next 2 to 3 quarters they able to recover these revenues back. So I think there is not structural challenge because of this decline or a huge miss which you are mentioning. And I am hopeful that gradually they would able to recover some of these lost revenues, because I think structurally, from a 3 to 5 years perspective, the spend in tech across the world would continue. And to that extent, if you look at the Indian players, Indian IT players, they have they are very significant participatory in this entire transformation. I think it's largely because of how effective they have been over the years in terms of right talent and right cost mix. So today, I think I believe that we are one of the cheapest cost providers, service providers, as far as technology services is concerned around the globe. And therefore, I think because of this entire thing, and there are many more technology innovations which are hopefully would come in the future. I think these companies will stay relevant, and then they will again get back onto the growth path.
So my question then, Vaibhav, from that perspective, we say that the long-term growth story for these companies is intact, and that is the thesis that I think you, as a fund manager, and a lot of investors will also bear in mind, especially if you're thinking of investing in a sectoral fund that is focused on tech and on IT. But what is your strategy going to be in this down year in terms of FY24? Likely, like you said, going to have moderate growth. You might see instances where there is a sharp dip in some of these stocks. Will you continue to bolster your holding in the stocks that you already have a significant holding in, or will you look to diversify? What is your strategy going to be?
So I think as far as technology fund is concerned, a large part of investment would continue to remain in IT services. Depending on the macro outlook, depending on the company specific outlook, I may change weightages from large cap to small cap and mid cap and vice versa. So that really depends on the business outlook, 1 year and 3 year business outlook, as far as along with what are the current valuations, and in addition, what is the quality of the management, what is the outlook on capital allocation, dividend payment, and so on and so forth. So I think based on these 4-5 parameters, I generally create my portfolio. And if we are in a very bull kind of an environment, then I would aggressively focus in small and mid caps. In a scenario where the growth rates are declining or it is coming off from the peak, it is tepid environment, then perhaps the pivot would be more towards large caps.
Okay.
The portfolios would have been completely different if you would have looked the portfolio somewhere in June of 2020.
Sure. So now, as I understand it, you have an allocation towards large caps primarily, or rather a significant allocation towards large caps.
Correct.
I would think that that will continue for the foreseeable future.
Today I have a large part of the money allocated in large cap tech.
Absolutely. Okay. Now, so you kind of answered my question on small cap as well, on the smaller IT companies, and we're yet to see the commentary. So I want to actually broad base this. And you've also spoken about some of the themes that you see playing out in the coming future as well. But there's one theme that I think a lot of people globally are talking about increasingly, and that is AI as a theme. A lot of applications here in India as well, a lot of development perhaps also taking place. Are you looking at trying to ride on that theme? Have you identified a few opportunities where you can invest?
So I think this generative AI which you are speaking, I think in India, as such, there are no direct plays. In US, maybe there are few companies which are direct plays. On a very fundamental basis, I believe that what has changed in last 5 years. See, this artificial intelligence is a very old technology. It's not new. It's maybe 30, 40 years in existence. What has changed in last 5 years is that first, I think there is a lot of data generation which has happened,
And computing power,
generative
right?
AI, because of so a lot of data generation or data creation have happened in last few years along with data collection.
Hmm.
And generative AI use require a lot of data as their input. The second thing, what has changed is on the semiconductor side, on the software, your compute, your
Yes.
ability to compute has increased significantly in last 5 years. It's a combination of these two things, which is now resulting in creation of a new interest in form of generative AI.
Hmm.
As far as exposure to generative AI theme is concerned, again, I think from an India perspective, indirect way to play would be through large cap technology names.
Hmm.
As far as US is concerned, again, I think it would be the large caps in US.
Hmm.
Large enterprise software companies in US, which would be the initial beneficiary of direct beneficiary of this generative AI. Essentially, I think you need three things. You need data, huge amount of data. You need huge amount of investments in terms of R&D, and you need huge amount of strength in distribution. I think all of these three things are available to large cap tech in US. As far as Indian IT services are concerned, they would participate in some of these stories either in collaboration with large cap tech in US or directly working with some of their clients in some of these diverse sectors. So that would be an indirect way to play that.
Supportive play. Final call then on FY24, both from your perspective as a fund manager and from the perspective of the investor. Do you think that there's going to be a significant need for patience, and you will, as a fund manager, utilize every opportunity you have to add to your positions, to buy on dips? Is that the strategy that you will take?
I think I would be investor in technology on every dip, because I think for me, from a 2-year perspective, from a 3-year perspective, the story is intact. It's just that in near term, there is a lot of volatility when it comes to US macro, European macros, and many other aspects, right? So in order to instead of timing the market, I would actually do a SIP,
Okay.
at least for next 6 to 12 months in technology fund, and whenever there is a massive drawdown, I can do a booster SIP.
Interesting. Okay, that's a great perspective. Thank you so much, Vaibhav, for joining in. Always a pleasure speaking with you.